The US economy continues to signal to investors that it's coping quite well with the high interest rates, which should strengthen demand for the US dollar. At the same time, inflation is slowing, which means that the Fed has no reason to keep monetary policy tight. Against this backdrop, the US dollar is still retreating to levels seen earlier in the trading week. In our video review, we will discuss how the week will start and what publications will influence investor sentiment. Markets will begin to assess economic news on Tuesday, and today investors will prepare for active trading, which will begin with the publication of a Eurozone gross domestic product figures on Tuesday. As a rule, markets keep a close eye on this indicator, as last quarter recorded a negative figure. Notably, the indicator points to a technical recession if we see 2 consecutive quarters of a decline. In other words, if the forecast of a recession of another -0.1% is confirmed, what has been predicted for so long has happened. The euro is likely to lose its investment appeal and come under pressure. Such shocking news takes time for traders to digest on Wednesday. The next important macroeconomic publication will arrive from Australia. The bullish mood is not expected. Most likely the statistics will show a slowdown in the growth rate of consumer prices, which means that the Reserve Bank of Australia may drop the issue of further interest rate hikes. A sell-off in the national currency usually offsets such a turn. Also, the Chinese manufacturing sector will unlikely support the Australian dollar. The manufacturing sector is the main consumer of the Australian commodities. According to analysts, business activity in the Chinese industry may slow down the rate of decline. The indicator will rise but will remain in the contraction zone below the threshold of 50 points. And the news may harm the Australian dollar and the market's overall risk appetite. Euro traders are also unlikely to stay optimistic, as the preliminary value of the inflation rate in Germany may increase speculation that the European Central Bank will consider the timing of interest rate cuts in the near future. In recessionary conditions, the economy needs stimulus. Since inflation is slowing down, the rate can be lowered to support local businesses. On Wednesday, investors will focus on the US trading session, as the results of the Federal Reserve meeting will be released. However, they will learn more about the employment situation in the United States. Of course, more accurate and important information will be published on Friday by the experts of the US Department of Labor. And on Wednesday, the experts of ADP will present their data on the change in the number of employees in the private sector. As a rule, the reports maintain a single trend. As we can see from the forecast, the increase in the number of employed should decrease significantly. The expected outcome of the Federal Reserve's Open Market Committee meeting is unlikely to reassure dollar buyers. The interest rate will not be changed, so all the attention will be on the forecasts and the rhetoric of the central bank in the accompanying statement. It remains to see whether the US regulator or the European Central Bank will start cutting rates earlier. If the US officials show their dovish stance, the US dollar will likely lose ground. We will monitor the market reaction to the above-mentioned reports. Subscribe to our channel and follow changes in market sentiment with us. Any comments, questions and offers are welcomed. We wish you profitable trading and see you soon.